Welcome back. Lecture 5. This one's called American Dreams, which is much fancier than auto insurance and renter's insurance and homeowner's insurance. So we're going to call it American Dreams instead, because that is the American dream, right? Have a car that runs, have a house that doesn't run. What is the American dream? Well, it's a way to live, or it's something to believe in. If you're a 1630 Puritan, it's a very formal definition of that. Is it the idea of, being free in what you can believe? Is it the idea of living, without some kind of king hanging around staring at you? Is it the idea that anybody can strike it rich out here? Is it the idea that someday you can own a home with a white picket fence? Is it a chance to learn something and move up in society and get status and prestige? Is it the hope that your children's lives will be better than your own? Is it a myth? How you define the American dream depends on who you are. These books are all about the American dream. All right, so here's a survey for you. What is the American dream? What is it to you? Which of those options is it? Well, now that you've already answered, 38% of Americans, this was about 8 years ago, believe that the American dream is possible. So that means 62% believe that the American dream is impossible. Or, are undecided. I should have ruined that. 41% believe it's impossible. 55% of Republicans believe it is possible. 53% of Democrats believe it is impossible. Pretty close. Flipped a little bit. Why are cars a thing? This is a big question of the day, right? Well, it turns out we live in a big country if you live in the United States. If you don't, then sorry, we're talking about the United States. This country has a lot of land, and cities are spread out, right? They're sprawling out, but they're also spread out from other cities, and people live far away from their work. So they get on, a bus, and no, we don't have that kind of transportation. They get in a car, and then they drive, right? It's a car-driving country of interstates for a reason. Plus, we still need a way to mark the passage to adulthood. So cars are that thing, right? Turn 16, get that license, get in a car, freedom, hit the open road, right? Road tripping. This is America. Cars represent freedom, independence, frontier, Americana. And, alternative ways of riding around typically are worse. Like riding a wolf is just not as comfortable. Jack Kerouac wrote a book called On the Road, which is a pretty interesting novel that you should read. And there's some great quotes in here about cars, which I enjoy. As I sat there listening to that sound of the night, I thought of my friends from one end of the country to the other. Now they were really all in the same vast backyard, doing something so frantic and rushing about. Those cars going back and forth. They have worries. They're counting the miles. They're thinking about where to sleep tonight, how much money for gas, the weather, how they'll get there. And all the time, they'll get there anyway, you see. Our battered suitcases were piled on the sidewalk again. We had our longer ways to go, but no matter. The road is life. I don't think he was far wrong. It's weird to think about, but a car isn't just a car, is it? It's a manifestation of our American lives. We need to be on some endless journey westward. West is always the direction of discovery, right? We always head west, toward the unknown, toward undiscovered frontiers. And cars promise to take us there. But will they take us there safely? That's the question of today. And the answer is no, because all other drivers are terrible. So you'll need a personal automobile policy, which is insurance for individual drivers. You probably already have this, and if you don't, and you drive, you need to get it. This protects you from potentially catastrophic wrecks. Now, throughout this lecture, there's going to be all kinds of videos that I'm not going to play, but you should actually just click on all these videos because they're amazing. And they're supposed to remind you that driving a car is one of the scariest things you do on a regular basis. So carrying protection is important. This personal auto policy can help provide for repair costs if you do get into an accident. Hopefully that doesn't happen. But it's also important for protecting you from liabilities if you cause the accident. Also, it's a safety net in case you happen to be wrecked by an underinsured driver or an uninsured driver. And it also covers the car, not the driver. So if somebody borrows your car and crashes it, Still your policy protecting that car. So I guess that's good, right? But don't loan it to anyone who's going to crash it. Carry proof insurance when you drive. So most states require split limit PAP. And what does that mean? It means they'll pay out a certain amount of money based on these different factors, right? And an Oregon driver's manual will tell you right here, the minimum that will be paid out is this 25, 50, 20 split. That's what you have to carry to be legally insured in Oregon. You can carry more than that, but you don't have to. So what does that mean? 25, 50, 20 split means that there's a $25,000 maximum that the insurance will pay in medical expenses for someone who is not you or your family. So again, if you're in a wreck, you're found to be at fault in some way, the other person goes to the hospital and they have to get some minor surgery and it comes out to being like $100,000. Well, they can collect $25K from your insurance. The middle number here, the $50K, is the maximum the insurance will pay for all medical expenses for others involved in an accident. So if you crash into a car full of people and they all require surgery, they can all get $50K total from your insurance. Any one of them can only have $25K of that though. $20,000, the 20 is the last number on here, right? The $20,000 would be the maximum the insurance will pay to repair someone else's property that you damage, right? So you notice these are all about the other person in the wreck. They're not about you. It's about how much they'll get paid for medical problems. It's how much their vehicle will be paid out, if it gets wrecked. So if you crash into a car that's worth less than $20,000, they'll get that money from your insurance. If you crash into a car that's $100,000, they can collect $20K from your insurance if you have a 25, 50, 20, but the rest of it's probably going to be on you. You should check out this split. Should you get this minimum auto coverage? Well, it depends, right? How much stuff is you're going to crash into and damage, right? Like how expensive is that going to be? You're going to crash into, a Volvo, or you're going to crash into a Lexus, or what, you got to think about like where you typically drive, right? Like if you crash into somebody's Maserati, you got bigger problems. How much is your stuff worth, but also how much is their stuff worth, right? Like if you total somebody's new Mercedes, it's probably going to cost more than $20K to fix that car. And if the insurance is paying $20K, oh, guess what? You're on the hook for the rest of that money, right? If you're found at fault. I personally have like 100, 350, which sounds kind of excessive, but it's really cheap. So I'm just going to keep that. That means that any individual can collect 100K if they get injured. The total for all their injuries, they can collect 300K from my insurance, and then if I do some damage to their car, it's up to 50K. So if I run into an SUV, most of that hopefully should be covered. Is that too safe? No. Have you seen the way people drive? Besides your coverage amount, PAP premiums are also dependent on your driving record, right? So how good of a driver are you? That's the dishonest question we always answer. And these will all raise your premium or even cost you your insurance if you are involved in accidents. That could cost you your insurance entirely, or at least it'll cost you more money. If you get tickets, it's going to cost more money. If you commit manslaughter, it's going to raise your rates. Please don't commit manslaughter. If you drive under the influence, good luck, first of all, being able to drive again, but also your rates are definitely going to be crazy. You might not be able to get insurance if you drive under the influence. If you're criminally negligent, same thing. You might not be able to get insurance. Definitely going to pay more premiums. If you drive without license or insurance, same deal. So don't try it, right? Other factors affecting premiums, having a good driving record will lower your premium, so it's cheaper, right? Having a good credit score will do the same thing. Taking a defensive driving course, bundling your insurance with other insurance will lower your rates. Being a good student, you can get a discount from that. Things that will affect it the other direction, being male will raise your premium, being under age 25 will raise your premium, living in a city, well, it makes sense, there's more cars in a city. Owning a luxury car will raise your premium, and commuting, especially commuting a long way, will raise your premium. Well, it's like, what else am I going to do with my car but commute, right? Insurance companies are like, okay, you can save money by paying us for insurance, and then just make sure you don't drive your car ever. You're like, thanks. Also, if you make claims from your insurance, expect your insurance to go up, which is sad, right? It's like if you use your insurance, it will become more expensive for you. Welcome to the world of insurance. Liability coverage. Underinsured drivers are those people who do not carry enough insurance or do not have any insurance when they drive. And your policy will also protect you when you're at fault in these kind of situations. There's also liability coverage that protects you when somebody else is at fault, right? So remember, the PAP is mostly directed at what gets paid out to the other person. Liability does a similar thing. It helps you cover things like medical costs, funeral costs, bummer, lost wages, punitive damage, car rentals, repairs, compensation for pain and suffering. Can't factor that one out. Generally, you won't need to pay the policy deductible for a liability claim, right? Because it's theoretically not your fault. Getting collision coverage is another thing entirely. So that was liability coverage. You're going to have that. Collision coverage is what happens if your car gets beat up, right? If your car gets crashed or you get into a wreck or some kind of accident, this insures you and whoever is driving your car with permission, right? Not like somebody joyriding in your car. It'll pay for car repairs if there's a problem. Most will pay the policy deductible to make the claim, and then, or you will have to pay the policy deductible, when you make a claim, and then after that, they pay the actual cash value of the repair, minus the deductible. Now, the only problem there is if they deem that your car is not worth very much, they might just decide, well, it's totaled because the amount of money it would cost to fix it does not outweigh the cost of the car itself. So you might get some money back, but then you still have to come up with a car. And if you make frequent claims, like again, if you use your insurance, you're going to get higher premiums, basically. If your car is more than 7 years old, it also might not necessarily be worth it because the costs, again, are going to be an issue. This one might work in the browser. Oh yeah, here we go. Only 2 cars on the road, and you can never tell who's out there. Comprehensive coverage is another step up, right? It's an optional coverage. It helps pay for damages to vehicles from a non-accident event, right? So you're going to have liability coverage, probably going to have collision coverage too. Comprehensive coverage, on the other hand, you have to make a judgment call about. This is something that will help cover your car if it gets covered in hail, or does a lot of damage, right? Or the windshield gets broken, or the vandals tear it up or something. And again, usually you've got to pay some deductible, which could be a chunk of money before they pay to get that stuff fixed. And the more claims you make, again, as always, the higher your premium. So try to protect your car as much as possible. You should check this one out too. I like this one. Making a claim. It's confusing. Okay, so what happens if you file a claim? Well, first you pay the deductible when you make a claim against your own collision or comprehensive coverage, right? You have to pay the deductible in order to get the insurance. It's like in healthcare, right? You got to pay the deductible before the insurance starts paying your bills. Same thing here. If you're not at fault, you make a claim against the other driver's insurance, right? You try to collect from them, or your insurance really should be collecting from them. And then you make a claim against your own collision coverage, which will help you get your car fixed, right? And hopefully their insurance will pay for that. If not, your insurance will help you pay for that. If you're not at fault and the other driver is uninsured, then you need this uninsured driver piece of it, right? Or underinsured. It makes a claim against your own collision coverage again to repair your own car, but you got to pay the deductible. Although maybe you might be able to sue the other driver and get them to pay for it. However, if somebody's driving without insurance, what do you think the odds are that they have the money to pay you if you take them to court? I think the odds are pretty low. Probably pretty low that they even show up in court. Well, maybe that's not true. Maybe they will show up. I don't know. Maybe they'll make a really compelling argument for why they shouldn't have to, because we live in a free country, right? Is it a free country, though? Is it? That's a discussion for another day. That's not part of the American dream. It's auto freedom. If you are at fault, you can't make deductible for liability claims made against the other driver. You can claim against your own collision coverage because you still need your car fixed, right? So even if you mess up and you crash into somebody, you can still get your car fixed through your collision policy. Company's just gonna be mad at you. So liability coverage, most people who drive obviously have coverage. However, you really want to have uninsured motorist coverage, because if somebody else does not have that coverage and you get hurt, or they get hurt, or your car gets wrecked, or their car gets wrecked, there's going to be problems, right? If an uninsured driver causes you to be in an accident, you're responsible for paying your own expenses, and that might be incredibly expensive out of pocket, right? So that's why we kind of need this coverage. And taking these people to court again is going to be tricky because their assets are likely limited. You might also consider getting gap coverage, especially if you get a new car, because as soon as you drive that car off the lot, what happens? Oh, it's worth less, right? It drops in value pretty fast. Gap coverage says, okay, if you get in a wreck, this gap coverage insurance will pay the difference between what the car cost and what its value actually is. Because remember, the insurance companies always only want to pay you for what they see as the value of your car. That's all they want to pay out. So if you get gap coverage, then they pay you out the difference, like what it costs you versus the value of the thing. So buy a new car, get gap coverage. Here's some good gaps, I think. Car accident survival guide. So if you are in a car accident, what are you going to do? Well, first of all, stop your car immediately. Please don't keep rolling down the hill. Move your car out of traffic if you can. You can be charged with a hit and run if you drive away after hitting somebody's moving or parked car, or if you hit somebody's stuff, or if you hit somebody. So if you feel a big bump when you're driving or an impact of some sort, you should probably get out and look and make sure that you're not doing a hit and run. If you hit a parked car or somebody's property, you're required to try to find the owner or at least leave a note with your contact info. So try to be decent. If someone is injured, call 911. Okay, makes sense. Shouldn't that really be step one? I guess stopping your car is probably more important. Like, I'll bring it to a rolling stop while I'm calling 911. Cause another accident. Step 3, exchange information with the other driver. So all this stuff, you know, your name, driver's license number, phone number, insurance company, all that kind of stuff. Also your car information, so the VIN, license plate number, make, model, all that good stuff. If the other person doesn't own the car, if at all possible, figure out who does own the car. Like take a picture of the registration if you can get it or whatever. If they're being really hostile about things, like, you know, I wouldn't force the issue, like don't get shot doing this. You should probably write down, you know, any names of people who are in the car and stuff. But after a while, it's like you're turning into a journalist, you know, writing all this stuff down. If there's any witnesses that decided to hang around and be helpful, then write down their information. But good luck with that one. If there is a police officer at the scene, then try to get, you know, figure out who they are as well. Write down their name. As soon as you try to ask for their name and badge number, though, they might start looking at you. So be wary of that. Draw a simple diagram of the accident. Take plenty of pictures of all the vehicles involved. I just can't imagine somebody actually like doing all this. Like, this is what you're supposed to do, okay? But like, if you're like, okay, cool, we got everybody's name. You know, we interviewed the whole street. I'm gonna go sit in my broken car for a while. I'm gonna draw some pictures of what this. If you can do that, that's awesome. But what you should really be doing is have your phone, right? First of all, call your insurance. And then like take pictures with your phone of this relevant information, right? Like people's names on the registration card and like the, you know, the license plate of the cars. And hey, stand back a little bit and take a picture of the whole scene, right? Click, 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 and then put all those photos on Instagram. Car accident survival guide. What not to do. Don't volunteer information about who is to blame, even if you think it was you. Don't start saying sorry, my bad, I messed up, because that stuff can lose you money in court, okay? Just say, is everyone okay? Hello, can I get your information? Thank you, goodbye, right? Call your insurance, don't agree to pay damages, don't agree to anything. Don't sign anything. Other than, you know, if an officer gives you something to sign, then sign it. Don't neglect to report accidents to the police, so please do report it to the police. Call a licensed tow truck. These guys surprisingly are not licensed. They are pretty clever, though, I gotta say. That's one way to push your car down the highway. Oh my gosh, his hand is so close to that other car. You know what? These guys are just living their life. Okay, so going back to Kahneman's world, let's talk about a little bit more about the mind that's involved in all this stuff. So I want you to think about something a little bit complicated. It's called Allais' paradox. So pick one option from these choices. You can either take a 61% chance to win $520,000, or you can take a 63% chance to win $500,000. Which of those two options do you prefer? Would you rather have the possibility of winning more money, a little bit more, or would you rather have a greater chance of winning? What about this one down here? Would you rather have a 98% chance to win $520,000 or a 100% chance to win $500,000? Is your answer different? Would you still go with the lower percentage and the higher money, or the higher percentage and the lower money? What's your preference there? It's starting to feel like a setup, isn't it? Well, what's interesting is that most people will choose a 61% chance to win $520,000, and they'll choose a 100% chance to win $500,000. 520, 500, 61, 100. Why is that different? Shouldn't they say, I'll always take the higher percentage chance to win, or I will always take the higher money? Why would they switch? That is paradoxical, isn't it? Is there a solution to this paradox? Are all percentage differences equal? What's the difference between 61 and 63 versus 98 to 100 when we're talking about percentages? What's the difference? The only difference is that 61 and 63 are both like pretty likely, but not overwhelmingly likely. 98% is extremely likely, and 100% is completely, right? So we go from extremely to completely versus lots to lots, lots to completely. 100% is more magical, right? Because there's no chance you lose. And some people will pay a little extra to have that no chance that they lose. It's not exactly logical, though, because if you look at the value of the money and the percentages there, you shouldn't be making that decision. But do we care about logic? No. System 1 doesn't care about logic. We don't treat statistics rationally. We don't evaluate what is the better value per cost here, because if we did, we would have answered that question differently. Whether it's about the likelihood of crashing our cars or it's about the chance to win a prize, we don't treat stats equally. Instead, we have different weights for how we make decisions. So let's say, for example, that you have a chance to win $1 million. And then your chance just improved, but how much did it improve? Well, your chance of winning $1 million from 0 to 5% is a massive difference, right? 0%, never, ever, ever going to happen. 5%, 1 in 20, we're suddenly like in the game, right? But your chance moving from 5 to 10% doesn't feel as big as that, right? Because we're not going from the realm of no chance into some chance. 0 to 5 says no chance to some chance. 5 to 10 says some chance to some chance. It's just not as big of a difference, right? And 60 to 65 is even less of a shift because 60 and 65 somehow feel closer together than 5 and 10 because 10 is twice as likely as 5. 65 is just a little more likely than 60. And then your chances of improving from 95 to 100% actually feel pretty big because again, we're probably going to happen to completely, totally going to happen. And that's a big deal for us. Like, what's the best improvement here, the biggest improvement? The biggest improvements are 0 to 5 and 95 to 100, right? Because then we're getting from nothing to possible, or from likely to permanent, going to happen, absolutely happening, right? Those are big deals. 5 to 10 and 60 to 65 are not as big of a deal. This is what's called the possibility effect. And this means that even if something's highly unlikely, like if you have a 0% chance to win the lottery, that's not that different than having a 5% chance, honestly, to win the lottery. But we don't see it that way. We see it as going from like 0 to lots of possibility. Because 5% is way more possible than 0%. So even though it's highly unlikely still that we win the lottery, we overly weigh that. We decide that that value is actually huge, despite that it's still 5% chance, right? That's why Han Solo says, never tell me the odds, right? He couldn't think statistically if he wanted to. So you're telling me there's a chance. Same thing, like just that the odds exist makes us overvalue them. There's also what's called the certainty effect. So that was the possibility effect. It's like if we go from 0 to 5, we see that as a huge shift. The certainty effect is also a huge shift. Outcomes that are almost certain to us are given less weight than how their probability, all things considered, should be evaluated. So the larger weight we place on the change of 95 to 100% is a big deal. So back when people were projecting, Hillary versus Trump back in 2016, most people said there was like a 95, 99% chance that Clinton won. Well, 95 is different than 100% because she didn't win, did she? There's also like the chance of Bitcoin doubling. Like what's the probability of that? I don't know, but this is pretty much how we function at this point. It's like the possibility that it will go up means we overvalue it. Like we decide it will go up just because it's hypothetically possible that it will go up. So what does certainty cost us? Well, it costs us money, right? Let's say, for example, that you are really fortunate and I lied to you last term when I said that no unknown rich relative will leave you money when they die. Let's say that somebody did. Unknown rich relative showed up and you're going to inherit $1 million. But somebody else is coming out of the woodwork and saying, I'm going to contest that $1 million. Well, the lawyer tells you, you got a 95% chance of winning the case. You're going to be fine. You're going to get that $1 million. So the expected value of the inheritance, 95% times $1 million, is actually $950,000. That's the expected value. That's what mathematically this thing is worth, based on the likelihood of it happening and the value of it. But if an insurance company, a really special one, came up to you and said, hey, we know you don't want to lose. We know you don't want to go to court and risk this. How about we buy your case? We'll give you $910,000 so you don't even have to think about it. And then we'll go out and try to win the case and make the million. Would you take that offer? If you could take a guaranteed $910,000, or would you take the chance on trying to get $1 million? Like, do you ignore the expected value and go with the certainty effect or not? Well, it's going to cost you money to do that, right? In this case, it costs $40,000 to be certain, depending on how you look at it. Now, do you want comprehensive car coverage? Turns out we're not rational decision makers. System one wants to feel safe, right? Doesn't want to make decisions that are potentially harmful. How much will that safety cost? How much is that comfort going to cost? Tversky and Kahneman actually calculated this. They went in and they tested people to figure out like how they weighted these percentages, like what kind of cost was there with 0 to 5%, right? Like possibility effect. And how much does that change by the time you get up to 95% or 100%? Like how do we value these things? And they actually came up with this really interesting chart. So it says like if the probability of something happening is 0, we give it a 0 decision weight. But even if there's a 1% chance it happens, decision weight shoots up to 5.5%. We overweight that just because it's possible. Is it likely that something will happen if it's 1% chance? No. But we way more believe it's likely, 5.5%. By the time you say there's a 10% chance, we weight that as almost being a 20% chance that that's going to happen, right? And then you look up here, once you get up to 90, we don't treat a 90% probability as 90% probability. We treat it as about 71%. We're like, it'll probably happen about 3/4 of the time. And it's like, no, it'll happen 9/10 of the time. You have to get all the way up to something being 99% likely for us to feel like it's about 90% likely to happen. Isn't that odd? We do not weigh probability the way that probability weighs itself. Like we should say, oh, it's a 50-50 chance. And we believe a 50-50 chance will go our way only 42.1% of the time. Isn't that weird? And something has a 99% chance of happening, we think that's only going to happen 9 out of 10 times. Humans are so interesting. We make our decisions emotionally, right? We're not statistical creatures. We're not mathematicians. We're not economists. We don't work like that. So we pay money for the certainty. We pay money, we pay a premium because we want to know 100%, right? We're willing to pay for that. And the possibility tells us, oh, we can believe in something even if it's very unlikely the thing happens. There's a difference in a 1% chance to win $1 million and a 1% chance to lose $1 million, but option 2 scares us. So then there's this other emotional component, right? It's like we like the chance to win, but the chance to lose is really, terrifying to us, even though it's a small chance. And so we tend to make decisions accordingly, right? Like if there's even a small risk of something happening, we tend to overweight that risk. And if there's a small chance of something happening, that's good. We overvalue that thing. Fear and anxiety are not bound by logic. You think about something like a nuclear meltdown from a nuclear reactor, it's very unlikely that will happen. But we tend to overestimate the possibility that, yeah, it could happen, right? There's always a possibility it could happen, but it's very unlikely that it will happen. But because of that possibility effect, our worries do not match the threat proportionally. We worry way more than we actually should. We worry until we have a 0% chance of a threat, but how many times in life can you have a 0% chance of a threat? Like how much does it take to get that kind of certainty? It's pretty rare. So we end up attaching value to all these gains and losses and not actually to the wealth itself. Remember back in 411, we talked about how much we hate to lose. Decision weights are not equal. This is part of what Tversky and Kahneman call the fourfold pattern. You don't have to know all this stuff, but this is all part of a project called prospect theory, which we're going to revisit actually in the next week or two. It deals with how we assess choices like losses and gains, and we don't treat them the same way, right? If there's a 95% chance to win something, we are risk averse. We don't want to take risks. We don't want to lose out on winning. But oddly enough, if there's a low probability chance of something happening, we do take the risk. We're like, oh, 5% chance to win 10? Yeah, let's gamble. Let's do it. I think I can do it. The really weird part, though, is this last chunk. If there's a low probability of something happening, of losing something, we stay risk averse, right? Which doesn't really make sense considering the other side of that, but we're going to come back to that in just a minute. This tells you, okay, here's the prospect, chance of something happening. This is what it feels like, right? Because it's not just a 95% chance or 5% chance. It's fear and it's hope and it's trying to avoid losses. So then we make these different behaviors based on that, and in the end we settle out of court because we don't trust juries, right? So here's a way to sort of break this down a little bit too. Top left cell up here, this high probability certainty effect, high probability of gaining something, we are risk averse. Bottom left over here, sorry, my other left, this is what's low probability but positive. This is like winning the lottery, right? The possibility effect. Just because there's a 5% chance something happening will make us overvalue that chance. It's probably not going to happen, but we think it could happen, which makes us seek that risk, right? We don't want to lose what we've already gained. That's the top left. But if there's a chance of getting something, we will take that risk. The bottom right corner down here, losses that are low probability, we're risk averse. That's where we buy insurance, right? We pay more than it's worth because we want to buy that peace of mind. And then this is a really interesting one, right? The top right up here too. This is where we take risks. If there's a huge chance of losing money, we'll gamble because hope dies last. And we tend to throw good money after bad money. So it's kind of a complicated chart, but we're going to come back to this again too, so don't sweat it too badly. But we tend to be risk-seeking in losses as much as we are risk-averse in gains. And why is that? Well, it's because after a while, we're not so sensitive to that gain and loss anymore. A sure loss is aversive, like we don't want it, right? Because our reaction to a $900 loss is not that different to a reaction to a $1,000 loss. We don't weight those things differently. We're like, losing 900 feels like losing 1,000. We'll risk a lot to not lose anything. Decision weight corresponding to the probability of 90%, like we talked about in the earlier chart, is only about 71, which is lower than the probability that it's actually valued at. So if something's 90% likely to happen, we still only think that'll happen 7 out of 10 times. So bizarre. The diminishing sensitivity is what you see on that bottom row up there, right? But we tend to overweight the possibilities that we could win, and that's what gambling is. Gambling is basically overweighting possibilities. It's saying, no, I think I can beat the odds. It's like, can you beat the odds? Probably not. Chris Guthrie did some research in this, and he found that in law, settlement offers the certainty that juries don't offer, and that's why people who are taking a case in, if there's any fear that you might lose something, like you'll probably settle. What's interesting though is if you're the defendant and you're likely to lose, like you have a weak case, like people in the top right category we saw before, those people actually will go to court because, I don't know, maybe they get lucky and they get a good jury, right? Like they don't have anything to lose, so they will take the risk. Frivolous litigation kind of depends on that too, right? The plaintiffs who are litigating are trying to gamble, and defendants are like, big companies that don't want to get besmirched by the media are like, let's settle to get out of here. Don't forget your diamond hands. All right, so having said all that, how do we weight more risks? How do we value the insurance accordingly? Like, how do we get the right kind of homeowners or renters insurance? How do we feel like we're making the right amount of risk? Just because there's the possibility of your house flooding does not necessarily mean that that's a factor in what you buy with your insurance. A peril, let's start with a couple of definitions here. Peril is something that causes you to experience loss. Hazard is a situation that increases the likelihood of a peril, right? So hazards lead to perils. So here's an example. Earthquakes are perils. Living in the Willamette Valley is a hazard, right? Living in the Willamette Valley makes it more likely that you'll get hit, sadly, by an earthquake. So what could happen to your stuff? Well, fire, hail, snow, flood, thieves, thieving little hobbitses, All these things could ruin your stuff. Insurance can help you with those, except for the hobbitses, because they will take you to court. Hazards are things that insurance companies worry about, right? Because they can't really, determine whether or not there's going to be a snowstorm that wipes out, the world. Instead, they just have to decide, well, what are the likelihoods of these things happening? How do we lower that likelihood? What are the things we can control, etc. So they're looking at a couple of different things. They're looking at morale hazards, which is your attitude, right? It's like, how careless are you? If you have like an open, in-ground pool in your backyard, like, is there some kind of fence around it or something, right? Or do you just not, you're like, oh, everything's fine. That's a morale hazard. Knowing that you even have insurance can be a morale hazard. It can make you reckless. And they often offer discounts to try to offset that. There's also moral hazards, which is you being immoral, right? Like being dishonest or cheating or filing false claims. But they're really mostly interested in morale hazards because there's more of those. If I'm just not careful about how I drive, that's a morale hazard. So what you should probably do is buy insurance, but then forget you did, right? Like, don't act like you have insurance. Don't drive like you have insurance. Drive like you have no insurance, but have insurance. These guys probably need insurance. 3 factors to know when buying insurance. Think about the peril you actually face. Like, if you don't live in the Willamette Valley, are you really going to face earthquakes? I don't know. Like, if you live in Florida, are you going to face hurricanes? You should factor that in, right? Estimate the likelihood of having a loss and its severity. And be careful here because, again, a 5% chance of something happening is 5%, not the 10% that we feel. And a 50% chance of something happening is not 42% that we feel, right? It's 50%. And determine how much you actually have to spend because you can't buy so much insurance that you can't live day to day, right? Like, you can't live so far in the future that there is no present. When you buy it, remember that whatever you're buying for is hopefully an unlikely event, right? And if you're buying for something that's unlikely but has a really high cost, like, I'm buying insurance because if my house is ripped to shreds, I still need a place to live and it's a really expensive loss. For other things, you can self-insure, right? Even if something has a high likelihood of happening, but the cost is low, you don't need to insure for that, right? Like, maybe on your car, you don't need comprehensive coverage because your car is really old and beat up and you don't really care if a tree limb falls on it at this point, right? Like, you can self-insure that. Many risks you can avoid, like don't play with matches. Here's Risk Matrix 2. Risk Matrix Reloaded. It's hard to say. Things that have a high probability of happening and also have a high risk associated, you just shouldn't do, like smoking in bed is a really dumb idea. Things that have a medium probability of happening and high risk, you also probably shouldn't do, like throwing insane parties that are destructive to your home. Things that are a low probability of happening but have a high risk or high cost associated with them, like tornadoes, you can insure against stuff like that, right? So you're really just thinking, like, what can I prevent? Maybe I'll throw up a security camera somewhere. Maybe I'll check the smoke detector's batteries, etc., etc. Like, you control the stuff you can control, and the cheap stuff you don't insure. It's the stuff that would cause a total loss or a huge loss, but are unlikely to happen. Those are the things that you're insuring, right? Only take the most necessary of risks. So with homeowners insurance, when you buy a home, you have to purchase homeowner insurance. There's usually 2 main HO policies. There's a named perils policy, which only pays out for specific things that are named, right? If it says, like, to protect you from fire and smoke and tornado or whatever, like, those are named. And you probably won't want that for your expensive home. If you have a special perils HO policy, this pays for any loss unless it is stated that it won't pay for that loss. So if it says, I will not pay for the mold problems that you have, or if there's a war in your backyard, it won't pay for those, but it will pay for the other things. It's usually made up of 6 pieces. It replaces your dwelling if it's destroyed. It replaces other structures if they're destroyed, but not as much value as the main house. It replaces personal policy or property loss, loss of use of payments, liability coverage, and medical payments. So basically, 6 different pieces of this. So it's kind of like car insurance. There is a limit that gets paid out based on who gets injured on your property and stuff. But ideally, don't have these hazards on your property that promote injuries, right? Like, let's try to avoid that. The cost of your HO policy will depend on, how expensive your house is, essentially, and all the stuff attached to it from that last slide. It also depends on the type of policy. If you're a special perils policy, will cost more, than just a named perils policy, right? Because it's covering for more things. It's like that umbrella. The higher your deductible, the lower your premium, right? So the more, so even if it's a cheap policy, I might have to pay a lot of money before they start giving me money, and vice versa. Knowing how old your home is and how close you are to a fire station and all that kind of stuff can factor into what they charge you for the coverage. Higher credit is better. It just always shows you're a responsible person, I guess. Although that's really no guarantee, is it? And then how frequently you make claims. Obviously, they'll jack up your costs if you make claims, and if you make too many claims, they'll just take it away because insurance, they would really rather just never pay out on, if at all possible. The deductible has to be paid before you get any help, and that should be based on your emergency fund, right? Like you should be able to fund the deductible yourself. You don't want to be taking out a loan to try to pay the deductible to get your house fixed up. The more you claim, the more likely your policy gets canceled. General rules to follow when managing sort of homeownership in general, but also homeownership insurance policy. Inventory what you own, right? Like take pictures of your valuables, video record things. List anything with a value over $2,500 specifically, and get personal property floaters for those things. Because if you have a really expensive, piece of art or jewelry, they're looking at just the replacement value of it, right? They're not looking at what it's actually worth or what it's worth to you. Beware of attractive nuisances. Pools are great and really, really dangerous. Playgrounds, trampolines, stuff like that. Anything that's relatively sketchy and involves children is like, it's going to cost you money, or worse. In a flood zone, you have to get national flood insurance now because private insurers do not do flood insurance. Excuse me, because they don't make money on it. So you'd have to get involved with FEMA, right? So definitely check when you're looking at buying a home. Is this in a floodplain? Where is this place? Also ensure that HO policy offers inflation adjustment replacement value, so not just what it costs right now, but what it might cost in the future to do that. And if your coverage is above 300K, you might consider looking at umbrella policies, things like that. If you're going up far beyond that, it's up to you, right? It depends on what is it worth to you? What's the hassle worth? What's the chance of something actually happening? These are the kind of calculations you have to make, and also maybe identity theft. Be careful out there. There's a lot of people who are not necessarily working with your best interests in mind, because they're definitely not working with their own best interests. Is it time to buy a dash cam? It's probably time to buy a dash cam. Anyway, involve System 2 in some of your decisions. You probably need auto and home insurance if you have an auto or a home. But paying so much that nothing bad can ever happen is probably also a bad game. So try to be realistic about that. Will it fix the fundamental problem of being afraid of the future? Maybe not. You want to have a qualified fear. Just because there's a possibility of something happening, like this chart shows us over here, does not mean it's actually going to happen. A few things to check out. Definitely read On the Road at some point. Let me know what you think. Like this card down here, it says, no airbags. We die like real men. All right, take care of yourselves out there. Don't die. Don't drive like real men. See you next week.